Hey everyone, and welcome back to another portfolio update for you today. So, over the past week, the couch investing portfolio was up 9.12%, whereas the S&P 500 was up 1.57%. Year to date, we're now up 50.2%, whereas the S&P 500 is up 12.17%. And since the start of the portfolio, we're up 139.8%, whereas the S&P 500 is up 32.34%. And so in today's video, I first want to thank all of the new members of the channel because your support over the last couple of weeks has been insane. The upcoming earnings week is basically, if you're a Manchester United fan and you rather follow the company's financials than the sporting achievements, then I guess Wednesday before the market opens, Manchester United will report its quarterly figures. As for the rest, nothing really that interesting. And then as always, we're going to go over some macro, maybe market data as well. And I do want to touch on Opendoor, SoFi, PayPal, and of course, Google. But first, let's touch on the portfolio. So SoFi still comfortably at number one here. Number two is of course Nebius. I mean, this is normal. This was bound to happen after it has gone up over 40% in just one day. We're at $90. At one point, it was at $100 plus. And, well, I did what I said I would do. And that's, well, I did buy more shares. I added an extra 15 shares at $87.91. Yes, I am averaging up after the Microsoft deal. So this was just a 4% increase of my position. And then I did close out the outlet position because, well, lost interest in raising cash here, which, of course, the timing was quite good. Now, with Nebius, I will keep buying more. That's what I said before. That's what I will say today as well. I will keep buying more because, yes, the stock is up significantly, but it's up significantly because suddenly we have the confirmation because, well, this was the thesis, but now we have the confirmation of here. Microsoft came in, $17.4 billion deal, 5 years, can go up to 19 point something billion dollars. And so, yes, this is a deal that was worth more than what Nebius was worth before the deal was announced. And so I have no issues averaging up. If we go back again under $90, I will keep adding more and more shares. The reason is, well, it's not a $100 billion company just yet. I believe very much in this management. I believe in the long-term future of this company. And I do think that, yes, there is a potential of this actually being an AWS, but in the age of AI. I think they have everything inside the company to make it happen. Of course, it won't happen overnight, but it's already quite nice to have the confirmation from Microsoft that they're on the right path. As for number three, Google making all-time highs. So here, Google at number three, 10.3% of the portfolio. Still view this as a cheap stock right now. Then we've got Rocket Lab back above $50. I don't know what has happened. I didn't find anything that, well, pushed this stock much, much higher over the last couple of days, but I'll take it. I'll take it. Rocket Lab here is up 486%. Of course, here as well, I am averaging up more and more. As we get closer to that Neutron launch date, I think things could get quite interesting. Of course, with regards to ASTS, we did have a drop in that stock price because of Starlink's acquisition of EchoStar. But as you can see, the stock right now is at an interesting spot, which was previously here a top, August 2024. Could this right now be a support area? Now, previously, yes, we've seen the stock go down under the moving averages, which right now it is under that 100-day moving average. It could, of course, go lower, and then you could pick up shares, even more shares, at $32, or we could see a little recovery here above that 100-day moving average in the coming days. Because 3 days from now, we do have a Fed meeting, and well, the question will be 25 basis point cut or 50. Currently 93.4% probability of a 25 basis points cut, 6.6% sits at 50. 3 days to wait. I think we can wait. Moving on to position number 5 here, and that's Micron. Has been performing exceptionally well this year. Micron went up on that City note price target upgrade. I think it was for $175. Right now we're at $150. $57. Micron will report their quarterly figures September 23rd, but we already had, of course, a month ago an update on guidance. Well, guess what? Guidance was raised, which was quite interesting because that came after we've had some reports where, oh, there might be some weakness in HBM, oversupply already, pricing issues. Well, clearly that did not affect Micron. Alibaba back at $155, that's up 71%. dLocal. dLocal is still underperforming despite me being up. I still believe that this is a stock that is underperforming. I will go over a couple of comments that were made by the CEO in an analyst conference, and I'll explain why I still view this as a buying opportunity, which is exactly why I will be buying more shares next week. AMD recovering nicely here. We did have also a nice little comment from Elon Musk saying that actually AMD is already quite good for the small and medium size models. Uber closing in on that $100 mark. Meta $755. Then we have Duolingo, still the only one where I'm red right now, although we did go higher than $307. So maybe there is a small recovery here because we were much lower at $258. And over the past couple of days, we have seen the stock rebound a little bit. Some think this is a dead cat bounce. Some other think that the market just looked at the company and said, yeah, it is maybe now too cheap to ignore. Moving on, we have the cash position, then still some PayPal shares, Oscar Health, which I made a video about, I did add a week ago, United Health, Upsellera, 3 shares of Nvidia and 1 share of Palantir. As for my options play, there is a little evolution here, and yes, I am now also a holder of BMNR. Blame Roy Crossroads for this. It's a YOLO bet. Okay, it's a YOLO bet. I am already up, which is fine. I'm not asking questions as long as this thing goes up. But on the options part, as you can see, I did add an extra one, which is the June 2026 $100 call option for PayPal, which means that probably I will reduce my share count even more because I don't really need so much exposure to PayPal. Why am I doing this? Because again, I do think that PayPal should be worth $100. Yes, I know options are riskier than shares, but I mean, I've been banging the table so long on this that to me, this is a must. Okay, I see the opportunity here. I see the huge upside here. I, of course, know my risk, right? Which shares, if it doesn't reach it, I still have my shares. With options, if it doesn't reach it, yes, I am, of course, going to have quite a big loss. But this is basically what is happening as of Friday with regards to my options, PayPal, and still Intel. As for the rest, Iron still have 900 shares. CoreWeave did add, so now we're at 204 shares. Applied Digital, unchanged here. Open, I did reduce my exposure once we hit $10, which means I have 10x that investment. And I will explain some things about Open later in this video. And so the game plan going forward is very simple for me. I will continue to add more shares to companies where I see a lot of value in. Right now, I still see it in dLocal. Of course, with PayPal, I have my options play, so that's the difference there. I'm still seeing some value in Nebius, of course. SoFi, if it weren't so big of a position, I wouldn't mind adding more. But right now, of course, I'm not really in a rush to buy more SoFi. Alibaba is fine by me. We'll see what happens with Micron after the earnings report. Rocket Lab, I will continue to average up opportunistically. And as for the rest, Oscar, United Health, these things are playing out as expected. But here as well with Oscar specifically, I will accumulate more shares along the way. And with Duolingo, I have enough and I think it will work out. Now, as for the watch list, I did of course add a couple of weeks ago. Well, I did add Chime and I did cover Chime actually. So go watch that video on the channel. Grab has started to move, reached $6 on Friday. Dave has been recovering very nicely over the past couple of days and weeks. Sezzle still under $90. I still believe there is definitely some value there, especially since it's still here creating that base right above that 200-day moving average. And since Klarna is also now a publicly traded company, maybe more buy now, pay later companies are going to get a little bit more attention. But of course, if we zoom out, we know very well that Sezzle has been crushing the market over the last 2-3 years. But I still believe there is definitely some value here if you're interested in adding a buy now, pay later fintech company in your portfolio. Moving on to some market data. So, what happens when the S&P 500 is up over 30% over the past 5 months? Here, we don't have that much data to work with, right? We have 1, 2, 3, 4, 5, 6 data points. Now, on average, we're good, okay? On average, as you can see, we are quite good. 60% of the time we were positive, 1 week later, 60% of the time 2 weeks later, and a month later as well. And then 2 months, 3 months, 6, and a year later, 100% of the time we were positive. Now, of course, this time it might be different. Looking at this, investors now have the lowest allocation to small cap stocks in history. Is this an opportunity? I think so. You have to pick, of course, the good small cap stocks because, yeah, it's true that the Russell 2000, the small caps, have been underperforming the market for quite a long time. And yes, more and more investors were going because of AI. I think it's because of AI. We're just going with the big players. It's safer and, well, the performance has been incredible over the last 2 years, 2.5 years or so. So why would you? Why would you risk it with small cap stocks? But this is an interesting data point. Maybe there is alpha to be found there. Looking at the total money market funds, we're at $7.5 trillion on the sidelines. Of course, it's an all-time high. And yes, of course, not all of that will flow into the markets either, but this is always something to look at. What's also interesting is this, paper losses. US banks are now sitting on $395 billion in unrealized losses as of Q2 2025. How did they do this? Honestly, I was quite shocked when I saw this. So share your thoughts down in the comment section below. Then, when talking about AI, we're of course talking about training and inference, more specifically the future. And the future here is quite clear. Within cloud AI, inference AI chips will outgrow training. These are the estimated figures. By 2030, it should be 80% inference chips, 20% training. Yes, I know AMD is well positioned, so is Nvidia, and of course Google as well with their TPUs, which is also why every other big tech company wants to have their own chips, because with inference, yes, you will need different type of chips for different types of workloads. Moving on here to the quickest 10x I've ever had, and that's OpenDoor. Now OpenDoor right now, on Friday, closed out down 13.8%. It went above $10. Market cap were at $6.6 billion, enterprise value of $8 billion, and revenue of $5.18 billion, which means you have your EV to sales forward of 2.3 and a trailing one of 1.6, with of course not that great of margins. Now Keith Rabois and of course Eric Wu are returning to the company, member of the board, and we also have the previous COO of Shopify becoming the CEO of OpenDoor. Now, as you know, OpenDoor became quite popular because of one specific Reddit post that was shared, and then Eric Jackson continued to talk about that quite a lot. Now, I've been skeptical about Eric Jackson and what he's been saying because yes, he was early with Carvana, but he also sold early with Carvana. He held OpenDoor previously, incurred quite a lot of losses, just so we know. But yes, he has been doing quite a good job for retail for pumping up this stock over 10x over the last 3 months. But a lot of the things that he has been saying are just incorrect. 1. The CEO of Shopify was not next in line to take over Shopify. Okay? That's just not true. Second of all, which was his big thesis, $12 billion in revenue fiscal year 27. Now that has become suddenly fiscal year 29. Where does he get that number from? I didn't see that. Actually, right now we're far from it. Fiscal year 27, $5.1 billion in revenue expected. So, okay, I don't know. Of course, things can change quite rapidly. Rates coming down, the company might accelerate, might launch new things. Of course, all of these things can happen, right? If we go back and we look at Carvana, for example, Carvana stock price peaked here Q2 2021, revenue peaked a couple of quarters afterwards when the stock was close to its all-time lows. And then, yeah, of course, the huge recovery. Looking back at Opendoor stock peaked here Q4 2020, right, when revenue was quite low. Revenue peaked Q1 2022 when Eric Wu stepped down December of 2022, just so we're clear. This was Opendoor's net income over the last couple of years, and this is what Keith Rabois had to say last week.
What do you do though with a meme stock? I mean, it's up 1,500.
It's not a meme stock. This is not a meme stock. So let's talk about what this means.
But isn't it all driven by sentiment? It's not fundamental.
Well, let's talk about this. What is the entire original point of having markets? It's to allocate capital, right? First principles. Markets are designed to allocate capital. Consumers are voting with their feet to say we want more capital being allocated to Opendoor. That's a good thing. That's how society should work. Like, I think the whole retail movement is misunderstood. It's better when consumers say, I want more of this and less of that. We don't need professionals. We need consumers saying, this is what is better for society, and I want to invest more capital
No, it wasn't a judgment. It's more that it would be risky because it's so driven by sentiment and online chats and that sort of thing.
Sentiment's different than potential. Potential, there's an option value on potential, period, right? Like, all of us learn how to price that stuff. And what has happened is the company was terrible at explaining the potential upside of the company. This is the Carvana comparison. Easy comparison to make. And the company wasn't even doing this. The company wasn't even engaging in standard investor relations, basic fundamentals. So when someone can articulate, why does this company matter? What's the potential? And why do we have an unfair advantage and accumulating advantages in getting there? Like, there's nobody else in the world. Either Opendoor is going to do this or nobody's going to do this. There's nobody even really trying.
How long does it take? Because for 2025, the projection is 11,000 homes sold and $4 billion in revenue. So that's going to could take a while to grow into this valuation.
This is a good question. I mean, again, as I said, I don't have access to financials yet. I'm going to start on Sunday and Monday, dive in, put together a strategy with the rest of the team. We're going to upgrade the team. We will have a plan. I'm sure we'll be presenting a pretty damn good plan before earnings.
Now, of course, we've enjoyed the insane amount of gains over the last 2 months, 3 months or so, right? No doubt about it. But you cannot tell me that this is about fundamentals or about, some people know that this might be. No, some people threw out some ridiculous price targets out there that are based on BS. Let's be honest here. Second of all, he was at the company when the company was burning money left, right, and center, just so we're clear. Third of all, he joins the company again, yet has not looked at the financials. Quite strange. I say it's quite strange because I did have back and forth with the guy on X a couple of weeks ago talking about the financials, and every time I said something and I proved with those charts here and with screenshots of their quarterly results, he said I was making things up. So I'm making things up, yet you have never looked at the financials recently? How does that make any sense? It doesn't. Moving on to something a bit more serious. SoFi, top 20 banks by reputations according to customers. SoFi here sits at number 4. Moving on to the other favorite fintech company, and that's PayPal. So PubMatic and PayPal, we did have a nice little report that came out. From transactions to precision, PayPal ads and PubMatic power commerce-driven advertising. For some reason, PubMatic's website looks like a notepad document. But anyways, at PayPal Ads, we're committed to pushing the boundaries of innovation in digital advertising by leveraging insights from the trillions of transactions that take place on our platform. Working with PubMatic allows us to deliver impactful advertising solutions through our transaction graph, helping advertisers connect with high-intent audiences based on verified purchasing patterns. So, we already have here a couple of results. The partnership is already demonstrating remarkable results by using verified audience segments instead of segments based on assumed interest. A national beauty retailer achieved something rare: strong performance across both broad reach and precision activation. So universal impact here, 8.2% brand awareness lift across all audiences. Precision results 21.6% brand consideration lift plus 17.3% brand recommendation lift amongst ages 18 to 24. These are, of course, early results and only talk here about one specific example, but these early results are quite promising. And yes, right now, PayPal's ad business is basically priced at zero when you're buying the shares. Quickly moving to Google. One, I highly suggest you go and listen to Demis's talk at the All In podcast. It's on YouTube and on Spotify. Second of all, Google Gemini here is, for the first time, above ChatGPT on Apple's App Store. One extra thing here, yes, it's very, very small data. When we look at first half 2024, first half 2025, growth or changes in sales for Apple, Samsung, Huawei, Xiaomi, Google, Apple is up 3%, Google up 105%. That's before the Pixel 10, of course, was launched. So this is mostly Pixel 9. And yes, it's this very, very small green bar right here. But imagine what can happen if Google can continue to grow and take market share for the next 5 years. How many billions of dollars can that add to Google's revenue and essentially to its bottom line as well? Last thing before I finish this off, dLocal's CEO was at the Goldman Sachs analyst conference. Like I said, after the earnings report, we do have quite a lot of analyst conferences where we do get a little bit more information. And so I do want to touch on a couple of things here. One, the extreme fragmentation of payments ecosystem, diverse regulatory frameworks, and multi-layered tax regimes across 45 emerging markets creates a significant barrier to entry for global merchants, making dLocal's single integration solution highly valuable. When people ask about their competitive advantage, this is one of them. Second of all, merchants diversification. While the top 10 merchants consistently account for 60% of revenue, the composition of this top 10 cohort changes significantly year over year. Only half of 2025's top 10 were in the 2023 top 10, indicating a more diversified merchant base than typically perceived. As for the stablecoin opportunity, stablecoins are viewed as an opportunity, particularly for on-ramps, off-ramps, and FX services. Leveraging dLocal's core capabilities in local payments and payouts, the company is also building capabilities for merchant acceptance of stablecoin. Then, when talking about take rate, they've been talking about take rate for quite a while, and they said the following thing. Management believes high levels of TPV growth are sustainable due to the vast addressable market and diversified growth vectors. They anticipate that TPV growth will continue to sufficiently offset the take rate compression, leading to very healthy gross profit dollar growth and strong EBITDA and earnings growth, potentially reaching or exceeding 75% adjusted EBITDA to gross profit margin in the midterm. So every time someone comes to you, is like, yeah, but the take rate, we know the take rate is coming down, but there's a reason why, and they've explained it time and time again. And in the meantime, if the stock does not want to go up, I'll accumulate more shares. No, this is not opportunity cost, this is opportunity. And so overall, to conclude, what a week for the portfolio. Congrats to all Nebius shareholders yet again, and congrats to most of you, because I've seen in the comments, a lot of you are, well, beating the market quite comfortably this year. And yes, there are still some opportunities out there. We didn't even talk about Adobe or Salesforce or any of the other beaten down companies, but beaten down and still cheap companies in the market. There are still opportunities. Probably the best opportunities are already in your portfolio. So overall, that's about it for me in this video. If you enjoy this type of videos, hit all the buttons. We really appreciate that. We'll see each other in the next one. Bye-bye.